Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough for the textbook Intermediate Accounting 17th edition. I just repeated myself. Authors are Don Kiso, Jerry Weingat, and Terry Warfield. This is the solution walkthrough for exercise 1427. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, let's have some fun. All right. So we're here at exercise 1427. I'm just going to go ahead and hide what I did earlier, bring that back later. So Vargo Corporation owes $270,000 to First Trust. The debt is a 10-year, 12% note due December 31st, 2020. Because Vargo is in financial trouble, First Trust agrees to extend the maturity date to December 31st, 2022, reduce the principal to $220 and reduce the principal to reduce the interest rate to 5%, payable annually on December 31st. Okay, so right over here. So we've got what's going to happen here is let's first figure out for Vargo is that do we have a gain on the extinguishment of indebtedness or the restructuring of debt? So the way we're going to do that is we're going to take the carrying value of the note payable. We have the carrying value of the note payable is $270,000. Under the terms of the restructuring, there's going to be a principal payment on 12/31/22 for $220,000. The other parts over here, so this is going to be the principal. And then we're going to have the interest payments on 12/31/21, and then we're going to have an interest payment on 12/31/22. The interest payments are going to be 5% of this $220,000 or $11,000. Okay, so right over here. So the total cash flows undiscounted are going to be $242,000. Okay. Okay, so what we're going to do here is that since the total cash flows on an undiscounted basis are less than the carrying value of the note payable, we're going to have a gain on debt restructuring. So the gain on debt restructuring is going to be $270 minus the $242 or $28,000. So how are we going to go through and do this? We're going to debit notes payable by $28,000, and then we're going to have a credit a gain on restructuring of debt. For $28,000. And this is going to be on 12/31/20. Okay. So what's going to happen over here is that when we have something happen, when we're going through, and you can go through and check out exercise 1424 because we had a similar situation. So when you have a situation like this, what happens is there's going to be no interest expense, because essentially what you're effectively doing is you've taken the note payable for Vargo. So my notes payable was 270,000. When I debit the note payable on 12/31/20, I end up over here with a carrying value of my note payable, which is going to be equal to the cash outflows that I'm going to be making for this loan in the next period, like over the next 2 years. So there's going to be no interest expense, right? What we're going to be doing here is we're going to be going, okay, we got 12/31/21. We're going to be debiting notes payable for 11,000, which is the amount of the interest I'm crediting cash on to record note payment on note payable on 12/31/22. We can do it one of two ways. The book shows a combination of the two, but I kind of like going over here and separating it out. So we've got our principal amount of 220,000. Okay. So effectively what happens on 12/31/21, 12/31/22, this is ultimately going to end up going down over here to a total of 0. So when I add up 11 and 220, 242, right, this is ending up at 0. So this is what happens for Vargo, right? So the first thing we have to do is that if we have the carrying value, the carrying value of the note payable, if that is higher than the cash payments being paid out, we have a gain on restructuring of debt. This is a little bit of an easier question at this point because then there's going to be no journal entries going forward for interest. However, for First Trust, it's going to be a little bit different. So First Trust, they have the note receivable they hold is at 270,000. However, they've agreed to accept fewer payments. So what's going to happen here is that they've got the principal. Okay, so the principal amount is at 220,000. When we go over here and we're doing the discount, we want to use the original amount of the note. So when we're discounting this payment, we're going to be using a 12% note. So Vargo is accepting less and reducing the interest rate. We'll kind of see how that plays out in a moment. But the first thing we have to figure out is what is the loss for Vargo Corporation? The way we do this is we take the carrying value of the note receivable, and then we're going to discount the future cash flow payments that we're going to be receiving from the borrower. So for this one, this is going to be the present value of $1, 2 periods at 12%. And we're going to come over here, present value of $1, 2 periods at 12% is 0.79719. And let's just make sure I did this correct. Okay, 0.79719. And then I also going to have interest payments. The amount of the interest payments I'm going to receive is going to be the 5% times the 220,000 or 11,000. So this one is going to be the present value of an ordinary annuity of $1, 2 periods at 12%. So again, this is I'm computing the interest payments based on the cash. This is all about cash being received, and I have to bring those future dollars back into today's dollars, and I do that by present valuing the amounts. So for here, I've got 2 periods at 12%, and this is going to be 1.69005. So the present value of the principal, I'm going to have the present value of the interest. So my total present value of the future cash flows is going to be 193,972. And my note receivable is going to be at 270. So my loss on debt restructuring we also call this just bad debt expense, is going to be 76,028. The way we're going to go through and record this for financial statement purposes on 12/31/20, I'm going to debit bad debt expense. I'm going to credit the allowance for doubtful accounts. Okay, so over here. So now, if I look at this in terms of T accounts, this is important because now we have to figure out the interest payments and the like. Okay, so my note receivable is going to be at 270. My allowance for doubtful accounts is going to be at 76,028. So the carrying value of my note receivable is going to be 270 minus the 76,028. When I go through and now figure out, the next thing I have to go through and do is figure out is my interest payment. So it's asking us to go through and to do the journal entries for First Trust for these next 2 years. So what I'm going to do over here is let's kind of make a payment chart. So my cash received. So I'm going to have 12/31/21, 12/31/22, and 12/31/22. And I'm going to break these up mainly just because I want to make sure that all of us kind of understand where the numbers are coming from. So this is going to be the amount of the cash that I'm going to be receiving. And I'll just kind of leave this last part off here, but I just want to basically the cash received for interest. Okay. So this is my cash received for interest. Okay. So my interest rate, I'm going to use the rate of the original amount, or 12%. My interest expense is going to be a function of the carrying value of the note receivable which is going to be the note receivable minus the ADA. So my carrying value of my note is going to be 270 minus my allowance for doubtful accounts of 76,028. So my interest expense is going to be the carrying value times the 12%, or 23,277. Why is this so different than the 11,000? Because it's essentially the spread of the interest expense. I dropped the interest rate to 5%. That's why there's such a large difference. So this 193,972 times 12%, that's how we're getting that value. The difference between the interest expense and the is going to be my ADA entry. And what did I call this before? I just want to see what I called it. ADA adjustment. It's fine. Allowance for doubtful accounts adjustment. So my allowance for doubtful accounts adjustment is going to be 23,277 minus 11,000. My carrying value now after my allowance adjustment is going to be 193 plus this amount. How do we do this as a journal entry? So on 12/31/22, so I'm 12/31/21. So I'm going to have interest. I'm receiving cash. I'm debiting my allowance. I'm going to credit interest revenue. So this should be interest revenue. Okay, so my interest revenue here is going to be $23,277. I'm receiving cash of $11,000, and then I'm debiting my allowance for doubtful accounts for $12,277. Now, what I'm hoping that has to kind of happen is that the carrying value, because I'm going to get paid $220 when I take my note receivable minus my allowance for doubtful accounts, that should equal up to $220,000. Okay, so this is 12/31/21. Now let's do the interest for 12/31/22. So my interest for 12/31/22 is going to be my new carrying value times 12%, or $24,750. And then my difference is going to be my allowance for doubtful accounts adjustment. And I'll just make this 13,751, and I get to the 220. So right over here, my allowance for doubtful accounts adjustment, 13,751. And I'm realizing now that some of these journal entries may not total up to the full amount, but it's okay. We're just rounding. It's off by $1. Okay, so this is to record interest revenue. So these would be my journal entries for the upcoming 2 years. Now, when I come over here to look at my allowance for doubtful accounts, I'm now looking at over here, this is 50,000 is my final entry, which is what I want. So the very last entry that's going to be taking place is that I'm going to be getting on 12/31/22, in addition to that interest payment, I'm going to be receiving cash of 220,000. But what I'm going to need to do is I'm going to need to credit my note receivable by 270. And then at the same time, I'm going to go ahead and debit the allowance for doubtful accounts by 50,000. Okay, so this essentially to go through and to complete that particular write-off. Right. But again, I don't record bad debt expense because why? I already wrote down the note on the date of the impairment. I would never delay the write down of the note. So that's why I'm recording it here. Again, what's this difference between the 76,000 and the 50,000 we're ultimately debiting here is that this is the true write-off amount that I'm finally being able to eliminate. And the other part is really the difference between the spread and the interest expense. So this is to record repayment of the note, basically to record the repayment of the loan. Okay, so that's how we go through, and that is exercise. This is exercise 1427. This has been kind of a big learning experience for me today. I've gone through and done most of these questions. All I can suggest to you is that, use Excel, go through on the different charts and make sure that your numbers work out. I want to thank Wiley for allowing me to use their content to give solutions for. Please don't forget to like and subscribe. If you'd like to see other solutions, please feel free to ask for them in the comments. Have a great day.